contemplations here. And we're going to talk today all about buying your own house and some things that you should know about that. Buying a house is an enormous responsibility for anybody on multiple levels. First, it's going to take a lot of money to pay for the house. There should be some saving involved for it. My wife, she sold real estate for years, and she would tell me the stories about when people would apply for homes and some of the difficulties they encountered. Plus, I also know from our own homes when my wife and I struggled to, make sure that we qualified for loans and so on and so forth. And then, of course, a home increases in value. So when you go to sell the home, you should be able to make a profit on the home, hopefully. All right, so the first thing you need to know is that there are multiple types of closing costs involved when you buy a house. It's not simply buying the house. You have to put down a down payment on the house, and depending on the kind of loan that you get, it depends on how much you have to put as a down payment. Generally speaking, the more money you put down on the house, the better, because your payments will be lower. There are what they call loan origination fees that the bank is going to charge you to make the mortgage. In this particular case, it's about 1% of the price of the mortgage of the house. There are escrow fees, monies that are going to go into the escrow account. They estimate it at 2% of the purchase price. They figure if you put 2% aside for it, you're in good shape. You have to pay a year of homeowners insurance up front, and you have to pay 6 months worth of taxes up front. And then you also have to buy things called title insurance, and that varies by location. So let's figure out some closing costs and some mortgages and so on and so forth. So mortgages, the down payment is usually 10 to 20% of the purchase price, okay? It all depends on the type of loan that you get, but that number 20% is really important, and we'll talk about that a little bit later in the process when it comes to figuring out what your mortgage payment will be. Then there are, of course, those closing costs that are associated. You're going to have to pay for home appraisal, and you're going to have to pay, they're going to do a credit report on you. The credit report's pretty cheap, but the home appraisal is not necessarily cheap. It's a few $100s. The bank usually doesn't pay for it, you do. The origination fees or discount point, where each point is 1% of the loan amount. So an origination fee, we just said, is typically about 1%, and you can buy points. And when you buy points, it decreases the amount of interest on your loan. If you're going to keep the loan for a long time, buying points is a really smart thing to do. If you're not going to keep the loan, then it's not. You have to put up 6 months of taxes, and this is where you live is a really important idea about what you'll pay in taxes. I used to live on Long Island. When I was on Long Island, my taxes were about $10,000 a year for 1/4 of an acre of property, which meant that if I was going to buy a new house, I needed to give about $5,000 down. Now, the $5,000 would go in an account and it would sit there at the bank, but I had to pay that up front because they in turn will have to pay it when the town asks them for the taxes. Most of this class is from New Jersey, where they also have very high property taxes. If you live in a state like Carolina or Tennessee, where the taxes for a year might be $1,000, this is not that big a deal when you go to close on a house. Insurance, you need a year's worth of insurance. My homeowner's insurance, I think it costs around $1,200 a year. Maybe it's $1,300 a year. You have to pay that when you go to close. You got to give them all of that money up front so that they know the house is insured. So heaven forbid something happened to it, the bank gets their money back. Title costs. Oh, this is a fun one. Depending on where you live is how involved this title is. In New York State, I think it's a complete rip-off bribery system. You have to pay for a title search. Then you have to pay to insure the title search. And then you pay insurance for the insurance. And I went nuts when it happened to me, and I said, you got to be kidding me. I'm not hiring the first guy. Why do I have to insure his work? And then what about insuring the insurance? And what happens is everybody's getting a little cut of your money. So you have to pay it. You don't have a choice. It's the way it is, in New York at least. I don't know how it is in other states. Escrow costs, that's money that gets put aside in an account. It's still your money, but the bank manages it for you for when they need to pay out expenses on the house. Now, be prepared for thousands of dollars in little costs when you buy a house. There are always little things that come up. Now, we talked before about that important number of 20%. 20%. See, if you take out a mortgage and you have less than 20% of the value of the mortgage paid off, then you have this thing called PMI. I always thought it meant something like primary mortgage interest. I don't know what PMI stands for, but you can sometimes pay it all up front. Sometimes you can pay it monthly, and usually most people put it in as part of their mortgage payment, but it is significant. It can be like, a couple $100 a month added to your mortgage payment. And they keep putting the PMI away until they keep the PMI, and they keep doing that until you own about 20% of the value of your mortgage. So the minute that happens, your mortgage then doesn't pay PMI anymore, and your mortgage payment would drop by a couple $100 a month. So it makes it wise when you put money down on a house to be able to put 20% down, because if you do that, then you don't have to pay PMI, and it'll save you a couple $100 a month. When do you have to do it? Here's the biggie. When your down payment is less than 20%. Okay? If you don't have at least 20%, then you have to pay PMI. And if you refinance your house, your loan to value ratio is over 80%, which is kind of like the other way of looking at it, as you have less than 20% stake in your house. Now, as far as types of mortgages go, my wife could tell you a lot more about this than I could, but there's a conventional loan. That's kind of what we went through. There's a jumbo loan. I'm not buying that expensive a home. There's government insured loans, and for that you have to jump through hoops. You have fixed rate mortgages. Oh boy, do I recommend those. Or you have adjustable rate, AMR mortgages. Okay. There's only one case in which you would consider an adjustable rate mortgage. Other than that, generally speaking, fixed rate is the way to go. And you got to watch out for the fine print. Always watch out for the fine print in the mortgages. Okay, so what's a conventional loan? A conventional loan is not backed by the federal government. It could come from a mortgage lending agency. It can come from a bank. There's conforming loans, which, as the name implies, conforms to a set of standards put in place by the Federal Housing Finance Agency. And the standards include a range of factors that include your credit score and your debts and your ratios, debt to income, and so on. But one of the main pieces is the size of the loan. For 2022, you cannot borrow more than $647,200 in most areas and $970,800 in the really, really expensive areas. Now, non-conforming loans, they don't meet FHFA standards. They might be for larger homes, or they might be for borrowers with subpar credit. One of the things you have to understand about credit on a loan is the worse your credit is, the higher the percentage rate you're going to pay on your loan. Now, the first loan I ever took out, I was a young kid. I didn't understand any of this stuff. First mortgage I ever took out. And we had some, maybe 2 or 3 dings for being 30 days late on a credit card payment and stuff. So I didn't get the best rate on my mortgage. And what that basically meant is I was paying, I don't know how much it was, $20, $50, $60, $70 a month more than a person with perfect credit. Now I have really, really good credit. So when I get my loan, I get the best rate possible. What does that mean for you? It means, should you happen to have a credit card, should you happen to have a car loan or anything like that, do not be late on any of your payments. Make sure your payments are in on time. And then you'll even save a little bit of money on your mortgage every single month. Or if you get a car loan, you'll save money on your car loan too. Now, what are the pros of conventional loans? They can be used for any kind of home, your primary home, your secondary home, and investment property. And the borrowing costs tend to be lower than other types of mortgages, even if the interest rates are slightly higher. You can ask to cancel PMI once you've reached 20%. You definitely want to ask for that, okay? And you can pay as little as 3% down on loans backed by Fannie Mae or Freddie Mac. I would strongly suggest not doing that, because you will be paying a fortune for your mortgage forever. And sellers can contribute to the closing costs. Like you might say that they're going to pay for, one of the closing costs. The appraisal is something they might pay for. The bad side of conventional loans, you have to have a score of 620 or higher often in order to apply for it. Some of them want a higher down payment, and you must have a debt to income ratio of 43%. And in some cases, it can even go to 50%. Okay, jumbo loan. Jumbo mortgages are appropriately named. They're basically for really expensive things. The pros, you can buy a super expensive home. The cons, the interest rates, and they also tend to be competitive, at least. That means they're pretty close to conventional loans. The downside, you definitely better pay at least 10 to 20%. There will be no 3%. Now you got to get a score of 700 or higher in order to get a jumbo loan. And I can tell you that I had spot on perfect credit. I was never, ever late for, I don't know, the last couple decades of my life. I paid things in advance. And my score, I think, was 710 or 720. So it's really hard to get a 700 or higher credit rating score. And you cannot have a ratio above 45% with the debt to income. And you have to have a whole lot of money put aside for them to approve such a loan. Who should get a jumbo loan? If you're looking to finance a super large sum of money and you then the typical limits, maybe a jumbo loan works for you. Government loans. Oh, these are the ones my wife used to talk about all the time, and whether or not so-and-so qualified for them. I'm not going to go too crazy here explaining all the ins and outs of government loans, but basically they are a way for people to start in the home buying business, okay? But, you know, like anything, you can see all the printing on the screen. The minute you get the government involved, there's a ton of red tape involved and a ton of stuff you got to go through. So personally, I like a life where the government is as far out of my life as possible. Unfortunately, not everybody can do that. But there are government loans, government-backed loans that can help first-time and other-time homeowner buyers. All right, a fixed-rate mortgage. Now, this to me is critical. You want a fixed-rate mortgage. My mortgage right now is 3%. That means that like inflation's creeping in right now, and as that inflation is creeping in, it's 7% for last year, and I'm only paying 3% on my mortgage. I'm kind of in a backwards way saving 4% just because I'm only paying 3% for my mortgage. This is a great rate. I wanted to fix it and secure it. So generally speaking, a fixed rate mortgage is the way to go. The pros of a fixed rate mortgage is that the monthly principal and the interest payments stay the same throughout the life of the loan. That'll never change. The only thing that can go up is taxes and insurance and stuff. And it makes it so you can really budget from month to month. To me, that's really important. Your budget will not change very much. Next, generally, we need to pay more interest with a longer-term loan, and that's a true statement. My 3% loan is on a 15-year loan. If I'd have gone for a 30-year loan, which I have no interest in, it would have probably been like 3.75%. Okay, and interest rates are typically higher than rates on adjustable mortgage loan. That's a true statement. That's one of the few things about ARMs that are good. Who should get a fixed rate mortgage? If you're going to be in the house at least 5 to 7 years, you should get a fixed rate mortgage. That's because even with an adjustable rate mortgage, usually it's set for a few years in the beginning before it can go up or down. Okay, next up, adjustable rate mortgages. Unlike the stable fixed rate loans, adjustable rate mortgages have fluctuating interest rates that can go up or down with market conditions. You might see a 7-year, 6-month ARM, which means that your rate will remain the same for the first 7 years and will adjust every 6 months after that additional period. So if that's the case and you don't plan on spending more than 7 years in the house, well, an adjustable rate mortgage is usually a little bit lower than a regular mortgage in terms of its interest rate. And you say, hey, I'll jump on this because I'm out of here in 7 years anyway. Maybe someone in the military who knows they're going to get out of the military in a few years but wants to have a house where they're deployed for now, and they have a commitment of 5 years. And they're like, well, in 5 years, I'm selling the house anyway, so who cares? That works for them. The scary thing about an ARM is, like, we're in an inflation rate right now, and what you're going to see happen is that the great interest rates, back when I got my most recent mortgage, we built the house in October of 2019. I refinanced in January of 2020, and the rates were, like I said, I got 3%. That's great. But since 2021, we've had interest rates inflation going up and up and up. And the way they control inflation going up and up and up is they increase the interest rates, and then that slows inflation. So, as those interest rates go up, which happens a lot, then those adjustable rate mortgages will balloon. So you might get an adjustable mortgage rate of, say, 4% now, but in 7 years, the interest rate might not be anywhere near 4%. It could be lower. I doubt it. More likely, it'll be 7 or 8%, and that's a huge monthly payment jump. Okay? Now, what do we have going on here? What goes into your monthly mortgage payment? When you figure out your payment, you got to pay your principal and your interest. You got to pay taxes. You got to pay your insurance premium, and maybe you have to pay PMI. That all goes into your monthly payment. Oh, I need to go back for a sec. How can you keep the payment as low as possible? Have great credit. That'll lower the interest rate that you pay. It'll save you a few dollars every month. By a few, I mean, $25, $50 a month. Have no PMI. That'll save you a couple of $100 a month. And then shop for insurance. Get a reputable company, but at a fair price. And when you do that, you might be able to save $300 a month on your insurance. Now, let's compare the following options and total loan costs in each of the following options. Option 1, you get a 30-year loan and an APR of 7.25%, or you get a 15-year loan at 6.8%. And both loans are fixed rates, and the closing costs are the same in both cases. They don't tell you how much you borrow, so it's difficult to actually compare them. But what you're going to see is that the monthly payment on a 30-year loan will be lower. The reason it'll be lower is because you're dividing it over more months. You're dividing it by 360 months. But the 15-year loan is only divided over 180 months. So you get more in that sense of the principal that you pay each month. However, because you're only, in option 2, taking a 15-year loan, you pay less per month. And on a 30-year loan, you actually end up paying, you pay less interest on a 15-year loan because you're only going to, if you look at the formula, raise it to the 15th power, or if you're doing it monthly, the 180th power. And in the case of option 1, it would be to the 360th power. So overall, you're going to pay a lot more. How much more? Well, that will be where the next video starts off.